Hello, my name is Jesus Viveros, and this is my project for how IPOs work, from private companies to public markets. So, what is an IPO? An initial public offering, otherwise known as an IPO, is a process by which a private company sells shares to the public for the first time, transitioning from private ownership of a public traded entity on a stock exchange. So primary market is new shares that are created and sold directly by the company to raise capital. Secondary market is an after is happens after IPO, which is when the company goes public for the first time, and the shares trade between investors on exchange like NYSE or Nasdaq. Um, Why go public? Companies pursue IPOs to unlock growth capital, reward early stakeholders, which are early investors, and gain market visibility. But the decision carries significant trade-offs. For example, raise capital. What is this for? It's for expansion, R&D, which is research and development, is short R&D for that, or debt repayment. It's also for liquidity. Liquidity, which lets founders, employees, or investors monetize their holdings. Like I said, early investors that lets them pull out their investment and use it any way they want. Brand and credibility, which enhances brand recognition and public status. So this helps the company get more out there. Like in this case, let's say for example Tesla. Tesla got more recognition for its shares that went up in value like so much in just 1 year. So that really has a good reflection on the company uh, when they go public and early investors happen to get a huge return back. The IPO process step by step. So the IPO process has 5 steps, and I decided to put this ones. It's to hire underwriters, which select lead investment banks. Due diligence, which prepares regulatory filings like the S9 and all that stuff that prepares them. The roadshow, which is the pitch to institutional investors, which is their loyal kind of customers, I guess. They pitch the stock first to them, and that's was the roadshow. Price discovery, they determine the offer price range. So to wholesalers, it's one offer, and then to regular people, it's like another offer. So they like figure that out to know how much to sell their shares for. And share allocation, which is distribute shares to investors. So the full IPO journey typically takes like 6 to 18 months and requires coordination among legal teams, auditors, investment banks, and regulators. Sorry. Key players in an IPO, the company. So the company is a key player because it shares and bears ultimate responsibility for disclosure and financial accuracy. So at the end of the day, the shares reflect how good the company is doing and how bad it is. So in case it goes good, pues obviously the shares are going to go up and keep increasing no matter what. If the company does bad, in some cases has a debt and doesn't know how to like repay it, but as the shares goes down and people lose money. Underwriters, which are investment banks that manage the offering and guarantee share sales. Like I said, these are the wholesalers. These are the people that sell the shares to the public. Institutional investors. Institutional investors, pues, like they're the ones that manage it, I guess. Like look at it. And retail investors, which are those who purchase shares once public trading begins on the open market. The retailers, like the people like me that just want to buy a share. The SEC and stock exchanges. So the SEC has, well, in this formula, there's six components that come up to it, which is the review S1 filings, the enforced disclosure rules, to protect investors, regulate exchange, monitor insider trading, which is very dangerous. Insider trading. It's what really screws up a lot of people. Approve listing standards. The SEC and Stock Exchange, which is a Securities and Exchange Commission, reviews the S1 registration statement to ensure full and fair disclosure, protecting investors without endorsing the investment. So this is a regulation that a lot of companies have to go through before going public. The NYCE is the world's largest exchange by market cap. So like it's home to like blue chip IPOs. Nasdaq, in the other hand, is a tech focused exchange, popular with high growth IPO candidates. So they're very not very different. Well, yeah, they're very different. Investment principles at play. So the things at play will be risk and return, which is IPOs carry high uncertainty, which is really true. Limited public data means investors demand a premium for risk. Stock evaluation. Well, what that means is basically like investors have well sometimes because there's some shares that do let investors vote on the table, pero like most of the time it's still the company running everything, so they have to rely on them. Stock valuation. Underwriters use DCF, comparables, and book building to set the offer price. Supply and demand. Offer price reflects institutional demand during the roadshow. Oversubscribed IPOs often pop on day one. Diversification. IPOs add sector exposure, but concentration risk is high. Avoid overweighting a single new use issue. Market efficiency. First day price swings suggest IPO markets may not be fully efficient in the short. An example I decided to put was Reddit's 2024 IPO, which was in this case, this is an AI created image, but it was $34, priced at the top of the $31 and $34 range on March 2024. At $50 at day one close, so shares surged 48% on the first day of trading on the NYCE. That means like it had a huge return for investors, and it had a market cap of 6.4 billion. Valuation at close of first trading day. Market cap is like the top, like that's what the top is. Like it can't get more better than that. 22 million are shares sold. 22 million shares sold, including a mix of new shares and existing shareholder sales. Reddit IPO risks and investors takeaways. Oh, Reddit IPO risks and investor takeaways. So there's a chart of like the offer price and the day one close. So like obviously the darker color is the offer price, which was just the sell price, and then would it went up to like would it shot up to in value. So in this case, if you would have bought low, was you had a 48% return, which is pretty crazy. And let's see some profitability concerns is Reddit was not yet consistently profitable at IPO, which is a red flag for value oriented investors, which is investors that really deep dive into companies to invest. AI licensing dependency. A significant portion of projected revenue relied on unproven AI data licensing deals. Lockup expiration. Insider shares became eligible for sale 180 days post IPO, creating potential downward pressure. And lesson for investors. First day pops reward early allocators, but often normalize patience and fundamental matters. Key takeaways. For companies, IPOs unlock capital and liquidity but introduce regulatory burden, disclosure obligations, and market scrutiny. So this means that obviously, even though a company goes public, like it still has its risks, and you have to make sure you study those before you actually invest in some. For investors, IPOs often offer growth potential but carry elevated risk. Evaluate fundamentals, not just first day momentum. So learn a little bit about the company, know that it's actually being taken seriously, not just because it's an early bird, you get the early worm. Like it's not always the best decision. Sometimes the company do get a lot of money and don't know how to manage it. So sometimes the company goes down. For markets, the IPO process for markets, IPO process bridges private innovation and public capital, the cornerstone of modern financial systems. And was my references the U.S. Securities Exchange Commission and the Nasdaq and NYSE with the Reddit. And that would be all for my project. Thank you very much.